Welcome to week 7. This is our Chapter 4 video lecture on long-term financial planning and growth. This chapter has a number of very important topics that's really focused on planning and the planning process using financial data. We're going to talk a little bit about what financial planning is, look at some financial planning models, look at the percentage of sales approach, which is a very common formulation for making plans. We're going to look at the need for external financing and how that need may limit growth, and discuss some caveats regarding financial planning models. But first, we're going to look at the process of financial planning. There are a couple of elements of financial planning, which is usually carried out by the CFO or the finance department. And the elements are important decisions that have to be made, and they are the outcomes of these decisions. So the first decision is, what are we going to invest in new assets? And this is determined by the capital budgeting decision. What new assets do we need? The second is the degree of financial leverage. This is determined by the capital structure, the relative amounts of debt and equity within an organization. The third is how much cash are we going to pay to shareholders, and this is determined by the dividend policy decisions. And then the fourth is the liquidity requirements, and this is determined by net working capital. What do we have in terms of our short-term assets and our liquid assets that help us to run our business on a daily basis? Are we liquid enough? So these are the four types of decisions: capital budgeting, capital structure, the dividend policy, and net working capital decisions that go into financial planning. As an environmental manager, you're probably going to be involved in the first one, investment in new assets. And you may get involved in liquidity requirements. But when you're looking at approving projects and recommending new equipment or new materials or something like this, you're going to be getting involved in the capital budgeting process. The planning horizon is divided into two parts: short-run decisions and long-run decisions. And the short-run decisions are usually for the next year, for the next reporting period, and long-run decisions are usually 2 to 5 years, or sometimes even longer. When you aggregate your decisions, you combine your capital budgeting decisions into one large project. This is very common in many organizations. The real important part of the financial planning process is to clearly state assumptions. Without clearly stated assumptions, the entire process falls apart. And so the assumptions have to be both realistic and supported by validated data. And one way to do this is to run several scenarios using different assumptions based on different sources of data, where you can vary the assumptions by reasonable amounts. So if you have one source that says that the change will be 5 and another source says the change will be 10, we'll run a couple of scenarios using the different data and see how the results come out. The goal here is to determine the range of possibilities, and generally these are bounded: worst case, normal case, and best case scenarios. Financial planning can help managers see the interactions between decisions. This is especially important for environmental management because many of the decisions around environmental management have integrative properties. In other words, they affect multiple parts of the organization. So financial planning is very important, and that's why you're taking this class, and that's why you'll need to understand it. Another aspect of financial planning is to explore options. And when recommending solutions as an environmental manager, the financial planning process offers a systematic framework for looking at different options for achieving the same. Another one is to avoid surprises, especially around risk-based activities such as those you're going to be covering as an environmental manager. Another one is to ensure feasibility and internal consistency. While you may think that your environmental project is the greatest thing since sliced bread, the managers may have other goals that they need to balance, and so consistency among the different goals is very important. There are many different types of financial planning models. We're going to look at some of the ingredients. Well, a primary ingredient is a sales forecast. Many cash flows depend directly on the level of sales, and this comes from the sales force generally and is estimated using the sales growth rate. Something called pro forma statements is very important for you to understand. It's a way of setting up the plan using projected financial statements that allow for consistency and ease of interpretation. They're essentially estimates of what the future is going to look like in financial terms. Asset requirements are also very important because the additional sales may require additional assets. If your machine can only produce 20 widgets a month and you're predicting that you're going to sell 40, you're going to need to buy another machine, another new asset. The financial requirements are also important because you may end up needing financing, take a loan or raise more capital through issuing additional stock shares to pay for the new machine. A plug variable is determined by management deciding what type of financing will be used to make the balance sheet balance. This is kind of you're making it fit based on what you think you want to do in terms of the four types of decisions that we discussed initially. The economic assumptions are very important. This is where most financial planning processes break down, is that these haven't been developed fully, they haven't been based on validated data, or they're just simply wrong. So let's take a look at a pro forma sheet. We have this gourmet coffee, assets 1,000, debts 400, equity 600 for a total of 1,000. We have an income statement, revenues 2,000 less costs 1,600, and then we have a net income of 400. If we have our initial assumptions set at a revenue growth at 15%, all items are tied directly to sales, and the current relationships are optimal, so we want to maintain those relationships. Then consequently all the other items are offset. So we can see here that our pro forma statement, or what we expect to see, is everything multiplied by the forecasted growth rate, especially revenues, costs, and net income. This is probably a reasonable assumption, although later in the class we're going to learn about the difference between fixed costs and variable costs, and we'll see that maybe this is just a little too general. And so we can see with a 15% growth rate, we're going to have a new net income of 460. Our balance sheet gets a little bit tricky because what we're seeing here is something called a plug variable, and in here we're using the plug variable of equity. In other words, we are adjusting the total assets, total debt, total equity, well actually total assets and total debt by 15%, and then plugging in the amount necessary to balance this out by changing the dividend policy. So we're shifting around the equity a little bit by shifting around dividends and retained earning. Here we have a different a plug variable, which is we want to have a different policy. We want to reduce debt, and so what this means that we're going to have to increase equity in order to hit our growth assumptions of forecasting 15%. So the plug variables are just a way of plugging in different numbers based on the other policies that are related to the sales growth. The percentage of sales approach is a very common method for financial planning. It's relatively straightforward, and it's important to understand that this information is coming from the sales department, so it can be a little bit optimistic. What we have to look at the effects on the statements. Costs may vary directly with sales, and if this is the case, then the profit margin is constant. However, depreciation and interest expense may not vary directly with sales. If this is the case, then the profit margin is not constant. We're going to see this illustrated later on in the class in terms of a concept called operating leverage. Dividends are a management decision, generally do not vary directly with sales, and this influences additions to retained earnings because the money that's paid for dividends cannot go to retained earnings and vice versa. On our balance sheet, we will initially assume that all assets vary directly with sales, but the accounts payable will also normally vary directly with sales. Notes payable, long-term debt, and equity generally do not vary directly with sales because they depend on management decisions about capital structure. And then again, the change in retained earnings portion of equity will come from the dividend decision, not from the sales forecast. So here we see a pro forma statement as a percentage of sales. We can see that everything varies directly as a percentage of sales, and we see simply that the pro forma statement is an estimate of the future impact of the growth in sales. We can also see here that the balance sheet is again varying along with as a percentage of sales, and what we're seeing is that the pro forma balance sheet is maintained as the current percentages of sales for the items that vary with sales. Now it's interesting to see that we have the notes payable and long-term debt and owner's equity that don't vary with sales. So let's take a little look at these numbers. We have our total assets are going to increase to 10,450, but the total liabilities and owner's equity will only increase to 10,250. So what are the implications? The implications are around external financing. Tasha's Toy Emporium needs to come up with an additional $200 in debt or equity to make the balance sheet balance. Remember, total assets minus total liabilities equals, well, total assets equals total liabilities plus owner's equity. It should be an equal sign. So 10,450 minus 10,250 equals 200. So we have a $200 mismatch here. So we either have to take out more loans, more debt, issue some bonds, or raise more equity through stock issuance. So where will the $200 come from? Again, we have four choices. We can borrow more short-term notes. This is short-term payable funds, commercial paper, things like this. We could borrow more long-term debt. We could sell more common stock, or we could decrease the dividend payout, which increases additions to retained earnings. So we have four basic choices, and these choices are interrelated with the other decisions that we need to make around the capital structure of the firm and how we want to maintain the relationships on the balance sheet. If the fixed assets are at full capacity, we have an important decision to make. Then we're going, if we're running at 100% of capacity, we're going to need new fixed assets. If we're not running at 100% of capacity, then we may not need to new assets. So if we're not, the decision is based on our sales forecast, do we require additional fixed asset? So suppose we're operating at our fixed assets at 80% of capacity. We want to grow 10% next year. The question is, do we need more fixed assets? And the answer is no. 80% plus 10% growth does not equal 100%, so we still have idle capacity. So at low growth levels, internal financing or retained earnings may exceed the required investment assets with no external funds needed required. However, as the growth rate increases, the internal financing will not be enough, and the firm will have to go to the capital markets for money, either through borrowing or through issuing new stock or new ownership shares. So the relationship between growth and external financing requires a useful tool in long-range planning because it really implicates changes in the balance sheet structure. And that in turn influences the ratios that we talked about, and in turn influences the market share of stock as well as the overall integrity of the firm. There are a couple of determinants of growth for any organization. The first is profit margin, which is operating efficiency. How well are we controlling costs in terms of revenues so that we have something left over to reinvest into the business or to pay the dividends to the shareholders? What's our total asset turnover? How efficient are we using our assets? Do we produce 1 unit a year, or do we produce 100 units a year from whatever assets we're using? Our financial leverage, again, is a is a result of a choice of an optimal debt ratio. Usually it's not zero, usually it's not 100%, it's somewhere in the middle, and the key is to choose the optimal debt ratio based on the particular industry and based on the financial goals of the organization. And also the dividend policy determines growth. How much are we going to pay to shareholders versus how much are we going to reinvest? So financial planning models are all good and well, but we have some caveats and some we need to examine. So it's important to remember we're working with accounting numbers, and so we need to ask ourselves some questions through the planning process. How does our plan affect the timing and risk of our cash flows? What is going to change based on what our achievement of the plan is? And does the plan point out inconsistencies in our goals? Are there different goals, perhaps for environmental managers and financial managers being addressed fully in the plan? And if we follow this plan, will we maximize owners' wealth? Will we maintain a good ratio between liabilities and equity? There are also some ethical issues. So when we know that there's going to be a budget cut, should we overstate requests for growth projections in order to maintain current? And this is a very common practice, but is it ethical? And if a manager's compensation is connected to forecasts, should estimates be understated to ensure making the target? If we're rewarded on making our goals, should we keep the goals low so that we're sure of making them? Again, this is another ethical issue. So, what are the most important topics of this chapter? Financial planning focuses on a firm's financing needs for the future. A pro forma income statement and balance sheet provide the financial picture for the future of the firm. They're just pictures about what we expect to happen in the future. Fixed assets are needed for growth above capacity, above the current utilization of currents. The percent of sales and EFN forecasting identify future funding requirements based on the need for new debt or perhaps new equity. And growth rate estimates can be computed for internal and sustainable growth of the firm. So if you have any questions, please post them in the Q&A thread. Otherwise, we will see you in the class shell.